Yeah, good evening, Trust.
Yes, good evening.
Yeah, Mr. Mohammed. Trust me, rested. Today is like public holiday. iPhone, please, mute. Completing my class, please, mute her, please. And please, more importantly, let us watch our speaker. It's not impossible that in the course of the lecture, you are not even aware. Your speaker might just be on, and that will conflate the class. So let us watch it. All right, tonight we are looking at a new topic. We are looking at capital structure and theories of gearing. We have treated corporate failure. We have treated capital reconstruction and business reorganization. Specifically tonight, we shall be treating capital structure and theories of gearing. Now, let us do an introduction to this topic. When we say capital structure, if you pick a company's financial statements, the financial statements will contain the income statements, statement of financial position, the cash flow statements, and other relevant statements that is required by law. If you look at the income, if you look at the statement of financial position, that statement details the company's assets. You have the non-current assets. You have the current assets. You have the liabilities, current liabilities, non-current liabilities. Then you have the aspects that is referred to as capital and reserves. Our discussion tonight is on that aspect, capital and reserves. That capital and reserves shows how the company is being financed. In other words, capital structure shows the different types of finance the company has used to carry out its business objective. Let us restate that. When we say capital structure, the capital structure of a company shows the financial structure, how this company is being financed, who and who has contributed to the finance of this business. That is the topic for tonight. Capital structure decision. By way of definition, capital structure can be defined as the different types of finance a company has utilized in order to finance its business objective. The capital structure will include the ordinary share capital, reserves, and long-term borrowing in the form of debentures. If you take a typical company capital structure, you are going to see ordinary share capital. You are likely to see equity reserves. Then you are likely to see long-term borrowing in the form of debentures, bond, loan stock. At times, business entity relies on short-term borrowings like bank overdraft, short-term trade credit as part of their capital structure. Now, why are we interested in capital structure? Why would companies be interested in how it is being financed? The issue is a company capital structure will have impact on its profitability as well as its market value. Let's take that again. The argument is how a company is being financed could have impact on the company's profitability and hence could affect the company's market value. If this is true, that means the company's management must pay attention to its capital structure. How you are being financed. Now, if you use equity financing, how? BB, please can you mute? Now, if a company utilizes equity finance, that company will pay cost for every finance choice. There's a cost attached. If you try to use equity finance, there's cost of equity. The cost of equity is the return to equity holder. So if a company issue equity to finance its business, that company is expected to incur cost of equity. If you finance your business with debts, the combination of cost of equity and cost of debt is what we refer to as weighted average cost of capital. This cost of capital, if it is too high, will affect the company's profitability. And that will affect the company's market value. I'm aware that you guys are treating cost of capital. You can see the relationship. How a company is being financed. A company capital structure could have impact on the company's cost of capital and could have impact on the company's market value. That means the decision about capital structure is the primary responsibility, is one of the primary responsibility of the finance manager. The finance manager must ensure that the company is financed in appropriate manner so as to minimize the cost of capital and maximize the company's market value. What are we trying to explain here? The importance of understanding company capital structure. A company can be financed by equity or debt, or a combination of equity and debt. Please note, a company can be financed by equity, or you can finance your business with debt, or a combination of equity and debt. What is equity financing? Equity finance is the finance, or it is the money contributed to the business by the owners of the business. Equity finance. This is the money contributed to the business by the owners of the business. The owners of the business, the shareholders. In other words, equity finance refers to all finance contributed to the business by the shareholders. Debt finance. Debt finance refers to all forms of borrowing. So you can finance your business by borrowing. You can finance your business by obtaining bank loan. You can finance, that is debt finance. You can finance your business by issuing debentures, a debt instrument. That is debt finance. You can finance your business by taking bank overdrafts. That is debt finance, or a combination of equity and debt. Right. Our next discussion. Before I move to the next discussion, if you finance your business by equity, with equity only, if you finance your business with equity only, such company will be referred to as ungeared firm. Please note that. Where a business is financed by equity only, such company will be regarded as an ungeared firm. If you finance your business by debt only, that is very, very rare. It is very rare to see a company finance 100% by debt. But what is possible is to finance your business by combination of equity and debt. In that case, the company will be regarded as a geared firm. So please note, if we say geared firm, that means that firm is financed by equity and debt. If we say ungeared firm, that means that company is only financed by equity. All right, next discussion. Risk. What is risk? Risk is the variability in return. When we say risk, risk is the variability in your expected return. The higher the variability, the higher the risk. You can measure risk by standard deviation, or you can use coefficient of variation. Now, risk can be divided into two. We have the business risk, we have the financial risk. Business risk. This is the variability of the firm's operating income. Variability in the firm's operating income. The income before interest and tax. Variability in the firm operating income is called business risk. When we say business risk, this is the risk that has to do with the nature of your business and the competitive advantage possessed by the firm within the business industry. When we say business risk, risk that has to do with the nature of your business. Once you are in that business, you are exposed to business risk. For example, if you have a bakery, whether the bakery is located in Lagos, or it's located in Kano, or it's located in Port Harcourt, they have the same business risk. Bread by nature is highly perishable. Maybe after 2 days or 3 days, that bread, even after 2 days, customers are not willing to buy. They will ask you for, give me a fresh bread. It's peculiar to bakery business. So if you find yourself in that environment, you must be conscious of the fact that the business is that this nature of business is highly perishable. If you are doing banking business, whether you locate your bank in Nigeria or US, they have the same business risk. Banks are highly exposed to fraud, both internal fraud and external fraud, because people are dealing with cash. There could be the temptation to take the money. Just 1 minute. Please, 1 minute. So please note, business risk is that risk that has to into. And also please note, where a company is financed by equity only, such company will only be exposed to business risk. Please document that. Where a company is financed by equity only, such company will only be exposed to business risk. Okay. Financial risk. Financial risk is the additional variability in returns to shareholders. Financial risk is the additional variability in returns to the investors that arises because the capital structure contains element of debt finance. Please note, financial risk will only occur if a company has obtained debt finance. Financial risk is purely associated with what? Debt financing. Where a company has not borrowed money, then that company will not have financial risk. Right. Our next discussion, gearing or leverage. What is gearing? If you are to define gearing or leverage, gearing is the extent to which a company is financed by debt. The extent to which a company has borrowed money to finance its business is called gearing. Gearing is the proportion of debt finance in the company capital structure.
I need a note of
Are you asking a question, sir? Or a side talk? That should be a side talk. They just allow the class to flow. Gearing can be calculated using market value approach or book value approach. Gearing can be calculated using market value approach or book value approach. But please note, unless the examiner states otherwise, gearing should be calculated using the market value approach. Gearing should be calculated using what? The market value approach. There are different ways of calculation, of calculating gearing. In most cases, you can calculate your gearing as total market value of debt to total market value of equity. Market value of debt over market value of equity. There are other alternative calculations. You can look at when we are referring to debt, please. In most cases, we only consider long-term debt. You can calculate your capital gearing as long-term debt divided by shareholders' funds. Or you can calculate it as long-term debt over long-term debt plus equity, shareholders' funds. Or you can use the third alternative. Excuse me, please. All borrowings divided by all borrowings plus equity. Different. In most cases, examiner will find the methods to use for you so that the student can have uniform answer. All right, let's go on. So please, when we say gearing, a company is geared. That means company has introduced debt finance into its capital structure. Our next discussion, theories of capital structure. theories of capital structure. There are two main theories that attempted to explain effect of changes in gearing. Please, when we say changes in gearing, changes in capital structure on the weighted average cost of capital and company's value. Let's take that point again. We have two main theories that explain the impact of changes in capital on the company's work These theories are: one, the traditional theory of capital structure, also known as the net income approach. Then we have number two theory, Modigliani and Miller theory, also called net operating income approach. We are going to look at these two theories. First, the traditional view of capital structure. The argument of the traditional theory, also known as the relevant theory of capital structure. The argument of the traditional school is that there's an optimal level of gearing. There's an optimal level of capital structure. When we say optimum, there's an optimal level at which you should stop adding debt finance to your capital structure. There's an optimal level of capital structure for a company. And this is the level of gearing at which work is minimized. According to the traditional theory, a company will be at an optimal level of capital structure, at a level of gearing, that is at a level of borrowing, at a level that you have debt finance, where your weighted average cost of capital is at the minimum level. In their arguments, as soon as a company introduces debt finance into its business, as soon as a company introduces debt finance into its capital structure, the cost of equity will rise. Why? Because equity shareholders will demand additional return. By bringing in debt into the business, you have increased the risk of the business. Hence, the shareholders will demand additional return. Therefore, cost of equity will increase. However, increase in gearing, there is greater proportion of debt finance in the capital structure. And the cost of debt is cheaper compared to the cost of equity. Why is cost of debt cheaper? Because with debt finance, the company will enjoy tax relief on interest payable. That tax relief can be used to reduce the cost of debt. Reduction in the cost of debt will reduce the overall weighted average cost of capital. It will get to a point, as you are bringing in more debt, cost of capital will get, WACC will get to the minimum level. Any attempts to bring in more debt finance, then the cost of debt will start to rise, the cost of equity will rise, and the WACC will also rise. So what traditional school is saying is that once you bring in debt up to a point that the WACC is at the minimum level, that means the company is at optimum position. At that point, the company must stop introducing debt finance into its business. That is the argument of the traditional school, that there's an optimum level of gearing where WACC is minimized, where the weighted average cost of capital is minimized, and the value of the company is maximized. That is the argument of the traditional school, meaning that capital structure is relevant to company's market value. Because capital structure will reduce the company's WACC. Reduction in WACC will enhance the company's market value. Hence, capital structure decision is relevant to company's market value. That is the argument of the traditional school. Is that clear, please? Any question? Okay. The second theory, Modigliani and Miller theory. The Modigliani and Miller theory, 1958, without corporate taxation, no taxation. Please. Now, the argument of Modigliani and Miller was that in the absence of taxation, capital structure is not relevant to company's market value. The summary of the argument of Modigliani and Miller is that if corporate taxation is ignored, then increase in gearing, please, when I say gearing, increase in your debt finance, that is what we refer to as gearing. Increase in, by bringing in more debt finance to the business, will not have any effect on the company's market value. Hence, capital structure decision is not relevant to company's market value, provided there is no taxation. If you like, finance your business with equity. If you like, finance your business with debt. If you like, use a combination of equity and debt. That will not affect your market value. That is the argument of Modigliani and Miller, provided there is no taxation. In their analysis, they argue that if there's increase in gearing, that means there's greater proportion of cheaper debt finance. We expect the cost of equity to increase as gearing increases. The cost of equity will increase. However, the cost of debt will fall. The net effect of greater proportion of the cheaper debt finance and higher cost of equity is that WACC remain unchanged. What they are saying is, if you are bringing in more debt, cost of debt is cheaper. Cost of debt will fall. Cost of equity will increase. The increase in cost of equity will be eliminated by the reduction in the cost of debt. The increase in cost of equity will be compensated by reduction in debt. Hence, weighted average cost of capital remain unchanged. In as much as WACC remain unchanged, then the market value of the company will also remain the same, regardless of the level of gearing, provided there is no taxation. That was the argument of M&M in the absence of corporate taxation. And their argument, the argument of M&M was supported with two propositions. The argument of M&M was supported with two propositions. Please note this. I'm not sure you are still, maybe you have finished cost of capital or you are still doing this, but please note this. M&M argues that if there's no taxation, the weighted average cost of capital in a GH company is the same as the WACC of an un-GH company. Please look at it. The WACC of an un-GH company, so the WACC of a GH company is the same as the WACC of an un-GH company. And once the WACC is the same, then value of a GH firm is the same as the value of an un-GH firm. Meaning that capital structure decision is not relevant to companies' market value. Proposition 2. The cost of equity in a GH firm is higher than the cost of equity in a non-GH firm. If a company is GH, the cost of equity will be higher compared to a non-GH firm. Look at it here, please. KEG, cost of equity in a GH firm is equal to cost of equity in a non-GH firm plus value of debt divided by value of equity into bracket cost of equity on GH firm minus cost of debt. You can use this to determine you can calculate your cost of equity using M&M approach. Please note this. You observe that the three formulas stated, you don't have tax in it. To assume that there is no taxation. So if you know the cost of equity of an non-GS firm, you can use it to calculate cost of equity of a GS firm if there is no taxation. We have defined these variables. Weighted average cost of capital of a GS firm, WACC of a non-GS firm, GS value, market value of a GS firm. Remember a GS firm financed by equity and debt. VU, total market value of a non-GS firm, a firm without debt. Debt is 0. When you have VE, value, market value of equity, market value of debt. KEU, cost of equity of a non-GS firm. KEG, cost of equity of a GS firm. Then your KD, cost of debt. All right. We have explained M&M where there is no taxation. We now have Modigliani and Miller allowing for corporate taxation. The first theory, M&M, assumes that there is no taxation. That theory was developed in 1958. In 1963, Modigliani and Miller included taxation in their model. With the inclusion of taxation, the inclusion of corporate taxation significantly changed the analysis of M&M. With taxation, M&M argues that value of a GF firm will be higher than the value of a non-GF firm, because the GF firm will take advantage of tax relief on debt finance. This tax relief will be used to reduce the overall cost of capital. The overall cost of capital is the WACC. Reduction in WACC will enhance the company's market value. So in their revised model, M&M argues that companies should utilize debt finance as much as practicable. As much as possible or as much as practicable, the company should utilize debt finance because debt finance is cheaper. The company will pay less tax because the company will save, will enjoy tax relief on interest payable. This tax relief will be used to reduce the cost of capital. Reduction in cost of capital will enhance the company's market value. So M&M come to the conclusion that because of tax relief on interest, there's optimum level of gearing that a company should try to achieve. They are now tending towards the traditional school. Without their 1963 model, including corporate taxation, M&M was tending towards the conclusion of the traditional school. They also developed two prepositions to support the argument that where there is corporate taxation, an on-GFM value will be higher than, a GFM value. Let me take that again. M&M developed two propositions to support the argument that where there is corporate taxation, the value of a GFM will be higher than the value of an on-GFM. Proposition 1, let's take it from here. The work in a GFM is lower than the work in an on-GFM. An on-GFM is all equity finance. Please note this equation. Work of a GFM is equal to work of an on-GFM, open a bracket, 1 minus dt divided by d plus e. Of course, your d is your value of debt. Your small letter t is the tax. Your e is value of equity. So the work of an on-GFM will be lower. And if the work is lower, the market value of a GFM will be higher than the market value of an on-GFM. Look at it here, please. Value of a GFM is equal to value of an on-GFM plus debt multiplied by tax. Next, the cost of equity in a GFM is higher than the cost of equity in an on-GFM. Please note this. Cost of equity of a GFM plus 1 minus tax, bracket cost of equity of an non-GFM, minus cost of debt, close the bracket, multiply by value of debt divided by value of equity. You can calculate you can use M&M theory to compute your cost of equity. Those are the two main theories that explain capital structure. We have other theories. We are just going to flip through this and move to question. We have static trade-off theory. In summary, the static trade-off says there's an optimum capital structure with an optimum level of gearing. The static trade-off theory argues that there's an optimum capital structure with an optimum level of gearing, and that level is achieved where the benefit of debt finance is equal to the cost of debt finance. The optimum level is achieved where the marginal benefit of debt finance is equal to the marginal cost of debt finance. That is summary. Debt finance. The marginal benefit of debt finance is tax relief on interest payable. The marginal cost of debt finance is the tax relief on interest payable. And the marginal cost of debt finance is the greater risk of financial distress. Where a company has borrowed money, that company is at a greater risk of financial distress. We have pecking order theory. Pecking order theory takes a different approach to gearing, a different approach to capital structure. For pecking order theory, there is nothing like optimum capital structure. For pecking order theory, there is nothing like optimum capital structure. Rather, companies show preference for the source of finance they have to use. Companies have preference for the choice of finance to use for their business. And that order of preference is what is referred to as pecking order. There's an order. There's an order of financing that will minimize the company's cost of capital. That is the concept of pecking order theory. That look, if you are trying to minimize your cost of capital, then there's an order of financing that can minimize the company's cost of capital. And that is what we refer to as order of preference. The first point is, if you want to finance a business, for pecuniary theory, the company will prefer to use internally generated funds. That is, the company should start with retained earnings to finance their business. Retained earnings are readily available and there is no cost involved. Retained earnings are profits, previous profits that is retained and not distributed as part of dividend. That means that cash is readily available. So company can utilize retained earnings first. That is the order of preference to finance their business. Number two, if you still require more finance, then you can consider debt finance. Debt finance is cheaper compared to equity finance. Then number three, in order of preference, you can now consider equity. You can now issue new equity. So this order of financing, we minimize the overall cost of capital. And this reduction in cost of capital will enhance market value. That is the position of pecuniary theory. Lastly, we have market timing theory. Market timing theory. This theory states that the choice of financing method for companies, the choice of financing method for companies can be driven by opportunities in the capital market. Meaning that how company will finance their business is dependent on the opportunity available in the capital markets. These opportunities occur because of asymmetry of information imbalance. For market timing, it is believed that the company's manager knows when it is more appropriate to issue equity finance or to issue debt finance. The company's manager should know when the future prospects for the company are better. You should know when to issue equity finance. The appropriate time to issue equity finance will be the time that equity is overvalued. Where the company shares is undervalue, the appropriate thing to do is to repurchase the company shares. That is the concept of market timing. You must know the appropriate time to launch equity finance or debt finance based on the opportunities available in the capital markets. Lastly, there's what we call asset beta and equity beta. When we get to calculation, we might need to introduce this, but let me explain briefly. When we say equity beta, in fact, when we say beta, so that let me explain it. Let me start from beta. Beta is an index that measures the level of risk. Beta is an index that measures the level of systematic risk. Risk that cannot be avoided. We now have type of beta. One, we have asset beta. Asset beta is an index that measures the level of business systematic risk or systematic business risk. That's better. Asset beta is an index that measures the level of systematic business risk. Asset beta measures business risk. Next, if you say equity beta, number 2. Equity beta is an index that measures the level of risk, systematic risk of a GS firm. Remember a GS firm, a firm that is financed by equity and debt. So equity beta is an index that measures both the business risk as well as the financial risk. Then number 3, we have debt beta. Debt beta is an index that measures the risk of debt only. It is assumed to be 0. Our debt beta is assumed to be 0 unless the examiner states otherwise. All right. When we get to calculation, I will bring those things in. Any question, please? Wow. Any question? We are done with the explanation on capital structure. Any question, please? If there's no question, let us look at that question that is attached to it.
Your screen is no longer moving.
I'll move it, don't worry.
Yeah.
Thank you. Please, who will read for us? I'm tired. Any volunteer?
The finance director of Cooper PLC is concerned about the impact of.
Sorry. Let me take it back. Sorry. I only want to move this down. Okay. Yeah. Okay. This is the question. The finance director, please go ahead.
The finance director of Cooper PLC is concerned about the impact of capital structure on the company's value and wishes to investigate the effects of different capital structures. He is aware that as gearing increases, the required return on equity will also increase, and the company's interest cover is likely to decrease. A decrease in interest cover could lead to a change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely: interest cover more than 6.5, credit rating AA, cost of long-term debt 8%. The interest cover is 4 to 6.5, credit rating A, and cost of long-term debt 9%. Interest cover 1.5 to 4.0 to 4, credit rating BB, and cost of long-term debt 11%. The company is currently rated A. Summarize financial data.
Please note that the company is currently rated A. That means the cost of debt will be 9%. You can go ahead.
Summarize financial data is as follows.
Okay, let me move it up small. Am I reading this? Are you going too fast, safe? Okay, you can go ahead.
Net operating income 110 million. Depreciation 20 million. Earning before interest and tax 90 million. Interest 22 million. Taxable income 68 million. Tax at 30% 20.4 million. Net income 47.6 million. Capital spending 20 million. Market value of equity is 458 million pounds. And
just please ignore the sign. We'll take it as Naira.
okay. Market value of equity is 458 million naira, and of debt is 305 million. Cooper equity beta is 1.4. The beta of debt may be assumed to be 0. The risk-free rate is 5.5% and the market return 14%. The company growth rate of cash flow may be assumed to be constant and to be unaffected by any change in capital structure. Required.
Just 1 minute, I'll move it. Required. Requirement A.
Requirement A, determine the likely effect of the company's cost of capital and corporate value if the company's capital structure was 1. 80% equity, 20% debt by market value, and 2. 40% equity, 60% debt by market values. Recommended, which capital structure should be selected?
We recommend which capital structure be selected, okay? Okay, let us deal with that first. Let us just look at if. We now come back to the B. Okay. Thank you for that reading. Now, let us ask ourselves, to what extent do we understand this question and the examiner requirements? The part A is for 20 marks. Examiner says determine the likely effects on the company's cost of capital and corporate value if the company's capital structure was Roma figure 1, 80% equity and 20% debt by market values. Roma figure 2, 40% equity and 60% debt by market value. Let me explain the question briefly. The question is about a company. And the company wants to know if we have a change in our capital structure, what will be the impact of this change on our cost of capital? And what is the impact on this change on our corporate value? That means if I'm to attend this question, just 1 minute, let me. Let's continue. If I want to attend this, understand the question I'm attempting. I want to know the effect on my cost of capital and on my corporate value. That means I will ask myself, what is my current cost of capital? What is my current value? I'm going to ask myself like 3 questions. What is my current capital structure? What is my current cost of capital? What is my current existing corporate value? Now, if you now go to changing capital structure, I will now ask myself, as a result of this change in capital structure now, what is my new cost of capital? What is my new corporate value? Does that make sense, please? Hello? Does that make any sense to us?
Sir, please, can you come again?
Yeah, at least you're asking a
Come
question.
again, sir.
The question says, determine the likely effects on the company's cost of capital and corporate value if the company's capital structure was 80% equity, 20% debt, or if the company capital structure was 40% equity, 60% debt. I will now ask myself, I want to know the effect of changing capital structure. That means I need to know the current capital structure. If we are changing to 80% equity, 20% debt, currently, what is our capital structure? I need to know it. If I get that out, I will ask, okay, what is our cost of capital? Then currently, what is our corporate value? I can ask, okay, as a result of change in capital structure, I will now ask myself, what is the new cost of capital? What is the new corporate value? With that, I can be able to know the effect of change in capital structure. Does that make sense, please?
Yes, sir.
Yes.
Yes, sir.
Okay. Let's go to the whiteboard. Let's see how this will go. Let's move to the whiteboard. Let's see how this will go. Wow, today is SFM day. Right, let me share the whiteboard. How many do I have? 1, 2. Let's see how we manage this. Please confirm you can see my whiteboard being shared.
Okay, sir. It's not shared. No.
It's not shared. We can't see it.
Not shared, Abby? No, well, I understand. Now confirm you can see it.
Yes,
Yes,
we can
sir.
see it.
Now step to the text. My first working. My working one. First, let's bring out the capital structure. Capital. Remember, when we say capital structure, how the company is being financed. The capital structure. Let's go to the question. Move a bit. Look at these notes. Market value of equity, 458 million. Market value of debt, 305. That means this company is financed by equity and debt. Is that not?
Yes.
So I'll come here. Value of equity, value of equity is 458. Value of debt is 305. Total value of the company, please sum. Value of company, how much, please?
763.
763. That means currently the corporate value is 763 million. Now let's take percentage. Equity percentage is equal to, our equity is 458 divided by total value 763. Please divide what you have. You can say multiply by 100.
60-40.
This is 60%. Okay, great. Thank you. That means my debt is, our debt is, if you work it out, there is equal to 305 divided by 763 multiplied by 100. This is 40%. That means the company capital structure currently, look at it too, current capital structure. Current capital structure is equity %60 and debt 40%. Is that clear, please? Hello? The class is silent. Is
It's
that
clear,
clear,
sir.
please?
It's clear,
Yes,
sir.
sir.
So currently, the company has equity percent of 60, debt 40%. The current corporate value is 763 million. Now, let's go back. We also need to know the current cost of capital. Let's look at the question. We are giving Cooper's equity beta to be 1.4. We have the risk-free rates and we have the market return. Can we compute cost of equity? Hello, I'm asking a question. How do we
That is based on all those formulas that you gave us before.
Yes.
While you were going through before we got here, right?
No, not this formula. Look at it. How do you calculate cost of equity? You have done cost of equity calculation on this class.
Yes. We can calculate it. I think we did CAPM.
Can you see
Capital asset pricing model. You can use that to calculate cost of equity.
Now, there are three methods of calculating cost of equity. You can use dividend valuation model. One. Number two, you can use what?
CAPM.
You can use
capital asset
CAPM.
pricing model.
Yeah.
Good. And you can use Modigliani and
M&M.
Correct. Thank you. That means if I look at this question, I have equity beta, I have risk-free rates, I have market return. I can use
You've not done M&M though.
Okay, you have not done M&M, Abi?
We're just starting it.
No problem now.
Yeah. No, but go on. It's okay. Just there to clarify that.
No, Ashebi, I know you won't still take you now. Okay. That means in this question, we can use CAPM to calculate cost of equity. Is that not?
Yes.
So let's go to it. We go to our whiteboard again. Now, I'll come here. Working 2. Is that clear? Working 2. Cost of equity using cap M. I'll put the formula B. KE is equal to RF plus beta bracket RM minus RF. Close my brackets. My KE is equal to RF. The risk-free rate is given to me as 5.5. The equity beta is given to be 1.4. Bracket return on market is 14 minus RF 5.5. Please work cost of equity.
17.4%.
17.4. Thank you. Now, why do I calculate cost of equity? Because I want to know the company's cost of capital. Currently, before the change in capital structure, I want to know the company's current cost of capital. And I look at the company's capital structure. I see cost of equity. So I see equity. That means I need to calculate cost of equity. I can see debt in the company capital structure. That means I need to know the cost of debt. Now, look at the question. What is the company's cost of debt? Anybody?
Is it not the 9%?
Thank you. The examiner says the company is currently rated A. That's a message to you. The company is currently rated A. I'll now go here. If this company is rated A, that means the company cost of debt is 9%. I can come here and I say, okay, the cost of debt is equal to 9%. I have cost of debt. I have cost of debt. I have cost of equity. I have value of equity. I have value of debt. Can I compute WACC?
Yes.
Yes, sir.
We can compute WACC. I want to know the current WACC of the company. I can calculate my WACC. Is that not? What's the formula for WACC?
They also give us tax rates, so yes.
Good, thank you. So what is the formula for WACC? You have not done it?
We've done it.
Cost of equity plus cost of debt.
Equity over equity plus debt times KE plus debt over equity plus debt times KD. Like that.
Okay. At least somebody is speaking that say yes. So I can just come here. I'll come here. Where's my come here. I'll just say working three now. That is the existing WACC. Existing WACC. The formula becomes my WACC for simplicity is equal to cost of equity multiplied by percentage of equity close the brackets, plus cost of debt after tax, cost of debt after tax, multiplied by percentage of debt. I can come here and say my work is equal to, I open a bracket, my cost of equity is 17.4. Percentage of equity is 60%, multiplied by 60% or 0.6. Let me do 0.6. I'll just come here and say multiply by 60%, got to 0.6. Close my brackets, plus open another bracket. Percentage of debt, debt is 9, but I must do after tax. Multiply by 1 minus, what is the tax rate? 30%.
30.
That is my cost of debt after tax. Close this. Then everything multiplied by percentage of debt, 40%, 0.4. Please work this out. You can close the bracket. Your work will give you 12.96%. If you like, use the formula Juwon has given you. Use percentage. It will still give you the same answer. We have computed the work. Please confirm the answer. Now, what we have done.
12.96.
Thank you. What we have done is to lay the foundation for the question. We have not started the question directly, but we have just laid the foundation. We have determined.
So how do you get 0.4? The last one.
0.4 is just 40%. Percentage of debt. Look at it.
But in the formula, I didn't see it.
Look at it here. Cost of debt after tax multiplied by percentage of debt.
Okay, I understand.
Now that means currently the company's cost of capital is 12.96. Currently, the company's capital structure is 60% equity, 40% debt. Currently, the company's corporate value is, please, who is this? Currently, the company's corporate value is 763 million. Now we can now go and look at it. If there is a change in capital structure, what is the impact of this change on cost of capital and corporate value? Is that clear, please?
Yes, sir.
I don't want to move this. We have to undo this. I know, not yet. Undo. I want to move this up. Okay. I will label this page 1. This is our page 1. Let me use red. This is our page. Why? No, what happened? Please undo. But make it fine, Sha. Now make it look somehow. I know. This is my page 1. No. This page 1. Move to the next page. Page 2. Okay. Now, examiner says new capital structure. New capital structure. Roman figure 1 now. We have, let's check it together. Look at Roman figure 1. 80% equity, 20% debt. Can we say it, please? We have 80% equity and 20% debt. This is the new capital structure 1. Let's deal with this first. Let me take you back to page 1 and the question. Let me go to the question. Or let me go to page 1. Look at page 1. We have 60% equity, 40% debt. At that point, our equity beta is 1.4. When the capital structure was 60% equity, 40% debt, the equity beta was 1.4. Please note, you may write it down. You may write it down. As soon as capital structure changes, that equity beta is of 1.4 is no longer valid. This equity beta of 1.4 was based on 60% equity, 40% debt. Now the capital structure has changed to 80% equity, 40% debt. It means that this equity beta is no longer valid. As soon as you observe that the gearing ratio has changed, the capital structure has changed, then that equity beta you are giving is no longer valid. In that case, you need to ungeared the equity beta. In that case, you need to ungeared the equity beta. When we say ungeared, it simply means convert convert that equity beta to asset beta. When we say ungeared, it simply means convert the equity beta to asset beta. When you are converting equity beta to asset beta, what you are trying to do is to remove the effect of the existing capital structure. The existing capital structure is 60% equity, 40% debt. So if you move back to our second board now, our page 2, the first thing we are going to do, because this has changed, 80% equity, 20% debt. The next thing we are going to do here, that should be working for. That should be working for. We say ungeared, the existing equity beta. Look at the formula to ungeared, please. Look at the formula. BA, that is asset beta, is equal to BE, equity beta, multiplied by VE, value of equity, divided by VA plus VD, value of debt, bracket 1 minus tax, close my bracket, plus BD, debt beta, multiplied by VD, value of debt, bracket 1 minus T, all over value of equity plus value of debt, 1 minus my tax. This is the complete formula. You want to convert equity beta to asset beta, meaning you want to ungeared. If you look at the question, I've given the complete formula. Examiner says the beta of debt may be assumed to be 0. That means if I come here, if the beta, this is beta of debt, look at it. This is assumed to be 0. This. If this figure is 0, that means everything here will equal to what? 0. In other words, I will only focus on the first part of the formula. Everything here is 0. I cannot come here and say my BA is equal to, our equity beta currently is 1.4. Value of debt currently is 60%. You can take the percentage to work, or you can use the absolute value. You are going to get the same thing. Value of debt is, it was 60%. 60 divided by, let that in this way. Value of equity is also 60. So the value of debt is 40 currently. 40 bracket 1 minus, the tax rate is 30%, 0.3. Please work this out and get your BA, asset beta. It's also called ungeared beta. This is what we call asset beta. Asset beta. They also call it ungeared. What do you have, please? Please work that out. If you work that out, you are going to get 0.9545. Please, you can reconfirm.
Confirmed.
What you have done, you have ungeared. The technical meaning of ungearing is to remove the effect of existing capital structure. The existing 60% equity, 40% debt has been removed. You observe that the gearing has now reduced because we have removed the fine. The figure was 1.4 before. Now we have removed 60-40. We have removed that 60% equity, 40% debt. That means we have removed the financial gearing. We have removed the financial risk. We are left with only the business risk. Asset beta is an index that measures the level of business risk. Any question, please? May God give us a better understanding. Please, you are going to deliberately try to understand and prepare for this in your exam. There's a strong possibility that you are going to deal with cost of capital computation in your coming exam. Now, you have removed the effect of 60% equity, 40% debt. What next? What you need to do next is to now introduce 80%. The new capital structure is 80% equity, 20% debt. You now introduce the new capital structure. To introduce the new capital structure, what you are going to do is to regear. We call it regearing. Regeared the asset beta using the new capital structure. There is no way you won't do this if you are doing cost of capital. There is no way. By the time you get to project specific cost of capital, you are going to ungeared, and regeared. There's no way you can't escape it. So my working 5. Please, let us try to show interest. I need to what? Regauge the asset beta using the new capital structure. If you say regauge, what we mean is that convert asset beta to equity beta. Look at the formula, please. This is equal to BE is equal to BA plus, open a bracket, BA minus BD, close your bracket, value of debt over value of equity into bracket 1 minus tax, close your bracket. Now come here, my BE is equal to my BA, we have computed 0.5954. I'll come here. Let me use this place. 0.59545 plus bracket 0.59545. My debt beta is assumed to be 0. This is minus 0. Close my bracket. Value of debt, look at this. For the new journey, debt is 20%. Equity is 80. Just come here. Pick the percent. 20 over 80. Then multiply is here, Abi. Into bracket, come like this, multiply by, I'll go down small here, 1 minus the tax rate, 0.3. Please work this out and get your new equity beta. Your new equity beta will give you 1.122. You can reconfirm, please.
Let's confirm some.
You observe now that the journey has changed. Equity beta has changed. With this, I can recompose cost of capital. So I can recompose cost of equity. My new cost of equity, because the journey has changed. What is this? I don't know how I even got to this side. How? I don't even know how much I've touched that in error. I'm coming, Jare. I know you not. But yeah. With this baby that is on my system. Now, with 80% equity, 20% debt, our equity beta is now 1.122. That means I can recompute cost of equity. Is that not? I will just come here. Our cost of equity too much. Maybe we should take a new page. Let's take a new page. So I'll come here. Please confirm you can see my new whiteboard.
You can see, sir.
Yes, sir.
Page 3. I can come here and I'll say, I'll take that working 6. Working 6. Cost of equity now. Because the gearing has, the capital structure has changed. Equity beta has changed. So I need to calculate new cost of equity. I'll just say my KE using CAPM is equal to risk-free rate is 5.5 plus our new equity beta is 1.122 brackets. Our market return is 14 minus 0.5. Please compute cost of equity as a result of change in gearing. What do you have? Since you have 15.04
15.04
or 3, I know it's between that share. You can see now. As a result of change in capital structure, what happened to cost of equity? Before, cost of equity was 17.4. Abi? If you recall.
Yes.
The cost of equity was 17.4 before. Now the cost of equity is 15.04. We have gotten cost of equity. Next, I want to know the cost of debt. If the capital structure is 80% equity, 20% debt. I want to know the cost of debt. Let me take you to page 1. That you appreciate why we are taking this. The page 1, look at it. When the capital structure was 60% equity, 40% debt, cost of equity was 17.4. Cost of debt was 9%. WACC was 12.96%. So now that the capital structure has changed to 80% equity, 40% debt. Sorry, 80% equity, 20% debt. Look at it. I've calculated my cost of equity to be 15.04. So the next thing is that what is my cost of debt? I want to know the cost of debt. If the capital structure is 80% equity and 20% debt, I will now come here. I'll come here. No wonder. I will go to working 7. Cost of debt. Cost of debt. If you look at the notes here, cost of debt is dependent on interest cover ratio and credit rating. True or false?
True.
Hello? If you look at it, to know cost of debt, you must know the interest cover ratio, you must know the credit rating. That will now give you where the cost of debt is lying. So I'll go back to that page 3. I'll put a note there. Cost of debt is dependent on interest cover ratio and credit rating. That means if I want to compose cost of debt, I need to know the interest cover ratio and the credit rating. We are going to do this here. Look at the workings. Wow. 15 minutes, okay? I will start with earnings before interest and tax. Let's check the financial we are giving. Look at the earnings before interest and tax. How much? How much?
90.
90 million.
And now you have to speak. 90 million. Pick it. I'll put this here, interest. I need to compute that because debt has changed. Interest. Now let me come here slightly. You know, we now have 80% equity, 20% debt. Abi? Now compute value of debt. Value of debt is equal to 20%. The total value of the company was 763. Please compute value of new debt. Please compute value of new debt. Value of new debt. Thank you. New debt is equal to 152.6 million. Now, we don't know the cost of debt yet at this new debt ratio. Now, let's assume the cost of debt will not change. Currently, our cost of debt is 9%. So please compute 9% interest. 9% of compute 9% the interest now. We have assumed that the interest cost of debt will not change. That means the interest is going to be 9% of 152.6 million. What is the interest, please? What is the interest?
13.734.
You can use that, but just silent. 13.734. I can bring this here. Okay. Let's assume the cost does not even change. I can bring this here to become 13.734. Now, please, what is interest cover ratio? How do we compute interest cover ratio? I'm asking the class. So I'm aware you have done FR, you have done ratio analysis, you have done.
That is the extent to which the profit covers the interest expense or interest costs of the debts. That is the interest cover ratio.
Thank you. The number of times the company's operating profit covers interest expense. Now, how do we compute interest cover ratio? How do we compute interest cover ratio?
In this instance, I think we can take the earnings before interest and tax as the profit divided by the interest expenses. So it will be 90 divided by 13.734.
Okay. Please, in all instances, not in this instance, interest cover ratio is calculated as profit before interest and tax divided by the interest expense. Is that clear, sir?
Yes, sir.
Is that point clear? So you know that, don't say in this instance, it's in all instances. The formula will not change. Interest cover ratio is calculated as profits before interest and tax divided by the interest expense. So please divide and give me the interest cover ratio. Interest cover ratio. Please divide and give me the ratio. 6.55.
6.55.
Now look at this. Let's go back now. If the interest cover ratio is 6.55, what is this company's rating?
We're told that we were rated A, but 6.55 is also in the it's now more than, it's not AA. It's not AA. That means they've moved from A to AA.
Thank you. With 6.55, the company's rating becomes AA. So at AA, what is the cost of debt?
9%.
8%.
That is 8%.
8%.
8%.
Thank you. We go back. I will now come here and say, I will say the credit rating is now, A. That means this company cost of debt. Cost of debt is now 8%. You have gotten cost of debt. You can compute new WACC. Look at it. You have cost of equity. You have cost of debt. You have percentage of equity, percentage of debt. You know the tax rate. You can compute new WACC. Our new WACC, that will be my working aids. Working aids. The new WACC is equal to, look at the formula, cost of equity multiplied by percentage of equity, close your bracket, plus, open a bracket, cost of debt after tax. I always put T there. Multiply by percentage of debt. I'll come here, our WACC is equal to, cost of equity is now 15.4, 15.04. Percentage of equity is now 80%.
80%.
That will give me 0.8. I'll close my bracket, plus my cost of debt is 8%. I need to remove tax, multiply by 1 minus the tax, 0.3. Close this, everything multiplied by my percentage of debt is now 20%, 0.2. Please work this out and give us the new WACC. $13.15. Please work this out and give us the new WACC. Please reconfirm your new WACC. Please reconfirm your new WACC.
Confirmed.
You can see now, what is the effect on our cost of capital? Our cost of capital is the WACC. Before, cost of capital was 12.96. When the capital structure was 60% equity, 40% debt. Where's my face? But look at it. When we have 60% equity, 40% debt, our WACC was 12.96. Now, when we have 80% equity, 20% debt, our WACC is 13.15. What has happened to WACC? What has happened to WACC?
It increased.
Thank you. By changing the capital structure from 60% equity, 40% debt, to 80% equity, 20% debt, the company's cost of capital will increase. The company cost of capital will increase.
That is like the tax effect because the debt is lower.
No, not the tax effect. Yes, you might be right, because now the debt is becoming lower. We are not enjoying.
Yeah.
We are not enjoying tax relief again. And if there's increase in cost of capital, then the company's value is likely to fall. We have tested the effect on cost of capital. You know, we are still dealing with Roman figure 1, Abi. Look at the question. No? We are still dealing with 1. Now, you know, you still have Roman figure 2, Abi. So, you challenge this Roman figure 2. Let me see the extent to which you can go. The only thing I will do now is I've looked at the effect. Roman figure 1, I've looked at the effect on cost of capital. And I want to look at the effect on corporate value. So that I will not excuse the class. Oh, time is far gone. I would have loved to do corporate value, so that if you can go back and now answer the A Roman figure 2 yourself. Let me see the extent to which we can go. Let's leave it at this, please. Any question, please? So far, we have tested the effect of change in capital structure on the company's work. We observe that if that capital structure change from 60% equity, 40% debt, to 80% equity, 20% debt, then the company's weighted average cost of capital will increase. And the increase in cost of capital will reduce the value of the company. So like I said, please, you are going to go and review what we have done. Now go and attempt A Roman figure 2. Look at what we have done and tell me the effect of change in capital structure from 60% equity to 60% equity, 40% debt, to 40% equity, 60% debt. What has happened to the work? We'll stop here. If I go to corporate value, it will take another like 30 minutes, 45 minutes. There's no point. But please, the assignment, I want to see that assignment before Tuesday, maybe maximum Tuesday next week. Let me even see the extent to which you guys can drive this. We shall complete the question next week. We can't go beyond this here. All right, any question, please? Any question, please? If there's no question, we stop here tonight. We pray God should give us a better understanding of what we do. And God should strengthen us. I will be leaving the class. Let us remain blessed. Good night.